Thank you. It's a pleasure to be here in sunny and friendly Sydney. I must start to tell you a little secret. I'm based in Stockholm, Sweden. That's more or less the geographical opposite to Australia. But on the financial market, we are very close. Why? Well, the economies are very similar. We have the same portion of financial, minings, commodities, sensitive for export, and also the same profile on demography with a lot of immigration. So the first thing a Swedish stockbroker check in the morning, that's the S&P SXS 200 in Australia. And every attempt to distinguish these two markets in the past have been futile. We are linked together, so you should check the Swedish stock market. That's a better proxy than Nasdaq and the Dow Jones. Over to the book. I was running a quite successful hedge fund, and we were in fact 3 years in a row nominated as the best hedge funds in Europe. But it was always some investors doing even better than we did. And I got a bit curious. Have they found the magic formula? So I started to do some research. And 5 years later and more than 5,000 hours, it ended up in this book, The World's 99 Greatest Investors, of which Anton is one of them. The typical investor is in the book. He's American, he's around 60 years old. He started early to invest in the equity market with some kind of value-based approach. He lives a quite sparingly and routine life with some odd hobby, beekeeper, stamp collector, close connection with his old university, and he's a big philanthropist. If we stop there in the analysis, we will draw the wrong conclusions. If you remember something from me and my presentation, let's see, there it is. It's this picture. It's not one success formula, it's plenty. It is as many success strategies as investors in the book. And some have the habits to invest on the top of the market and some in the bottom. Some have 1,000 shares, some a handful, some retain the investment in a couple of several decades, meanwhile others just a couple of seconds. But despite these differences, it's more that unites than divides them. It's possible to discern a common behavior of all the investors in the book. And I have listed 12 factors in the book which unite them, and I will go through a couple of them now. On average, the investors in the book have delivered 12 percentage points better performance than the benchmark in 25 years. That's an amazing figure. And I thought that must be at the cost of higher risk. But it's the opposite. They operate with lower risk. They avoid risk. They would never invest in a position where you have tenfold potential but 100% downside. They look at the risk instead of the potential. It's not the big wins, it's the absence of big losses which create the success. This guy, you can find him in the Guinness World Record book. He has the biggest biceps in the world, and he has found his niche in life. And that's the same with the investors, the best investors. They have carved out a little piece of the financial markets where they're more or less best in the world, and they stay there. They do not jump around. The investors become champs by limitation. It could be commodity derivatives or consumer goods, stocks or debt securities, but they stay there. This is chameleons. This is for me the biggest surprise. I thought that the investors, they develop a strategy and then they hang on, whatever happens. But they are flexible. And if we think a step further, it's quite logic, because the financial market is extremely competitive. If something works very good, everyone would like to join. It's at least 20,000 computers out there scanning the market every second for performance. And when it getting too crowded, the best investors, they're taking a little bit different direction. It's the same method, but a different selection criteria. It's like the theory of evolution. It's not the strongest, it's the most adaptable that survive. Even Warren Buffett, he says that he invests at the same way as when he started 60 years ago. He also changed. He started as a value investor and then became a quality investor, and now he even invests in IT stocks. He is now the largest shareholder in IBM, something he avoided before. You maybe know this Peter Lynch, the famous investor in manager in Fidelity. He beat the market 13 years in a row with roughly 16 percentage points with a $20 billion fund. That's amazing. His nickname was the chameleon. To become a good investors, it's not a walk in the park, unfortunately. It's a lot of work. It's an American author called Malcolm Gladwell. He's written a book called Outliers. Maybe some of you have read it. And he have stated in that book that it takes around 10,000 hours to become a good professional. And it's the same with investors. It's a lot of hours. I haven't found any born talent to be a good investor. The talent is to have the energy to read a couple of annual reports before going to bed. Warren Buffett again, he appears to have said sometimes that he used to take the decision on the back of an envelope, 5 minutes roughly. I have a friend who is a CEO for an insurance company in Europe. He was most recently called up by Warren and asked to come to Omaha. If Buffett calls, you go. And they were sitting in 3 hours going through every figure in the annual report. It wasn't any 5 minutes. But the beauty is that you could keep on working very, very long. And you're getting better and better with experience. It's like a bottle of red wine. And I think it was roughly 25% of the investors in the book are or were still active after 70 years old. 10% after 80. It even looks like you could prolong your life by investing. It's true. I spoke with Irving Kahn. He's 107 years old, and he goes to Wall Street 5 days a week. So maybe you should, instead of just solving crosswords and Sudoku, invest instead. That's more profitable. I've asked all investors in the book to share the 3 most important insights from working in the market. And this is the most common advice. I guess they have all learned the lesson. I think it was Einstein said that simplicity is the highest form of intellect. So keep it simple. I'm confident that all of us in here, we have made some bad deals in the past. And you know the feeling. You're thinking about this position every minute. You just would like to get rid of this plague. And some 50% down or 70% down, you sell. Probably at the wrong time. The guru investors, they handle the reptile brain by have a method and a model, a system for each position. And this is the same conclusion as Daniel Kahneman. I don't know if you know him. He's a former Nobel Prize winner in economy and also author of the book Think Fast and Slowly. And he has made much more research of this than I have done. And his conclusion is that you shouldn't rely on your emotion. You must rely on methods and models. Okay, what asset class has created the most successful investors? Well, it's stocks. Equity market, well, 80% roughly wholly or partly operate in the equity market. And those of you who remember 80s and 90s, seems obvious. But the last 30 years, the bond market and equities has more or less the same performance. The main reason why equity is dominant, I think, is that there is the possibility and opportunities to make a difference. And finally, the most common strategy in the book, that's value investing. And I must admit that when you have this selection criteria by 25 years, as a value investor, you have some kind of advantage. The opposite is the traders. They are not as persistent. But don't read this table wrong. The market is full of failed value investors. And from time to time, value investors performing weaker. But I'm confident that due to these periods of poor performance, that explain why this strategy still works.